In development debates today, our topic is if the drop in housing prices will lead to China's banks going bankrupt. The house prices in a number of smaller Chinese cities have been dropping. This year in March, the housing prices in Hangzhou plummeted, but the timing of the price drop angered recent buyers. This led to protests and rioting from these buyers. This started a chain reaction of price drops and spread greater fears in the industry. As of the end of March of this year, the prices of second-hand houses dropped in over 14 Chinese cities, including some first-tier cities such as Beijing and Shanghai. The sales in Shanghai have decreased by 25% from last month, while Beijing has had a fall of about 13%. Data from the Chinese government shows that in the first quarter of this year, the sales area of residential houses in China has totaled over 1,900 million square feet, a drop by 5.7% from last year. The sales of residential houses throughout the country have also dropped by 7.7%. That drop is valued at over 1 trillion yuan from last year. It's the equivalent of about 176 billion US dollars. The house price drop in China's real estate market has gotten many people's attention. A few Chinese economists are concerned that will increase risk for China's banks. Some of them even allege the price plummet in the housing market will lead to bankruptcy. But recently, a report released by an American think tank called the Peterson Institute for International Economics says the house price drop will not influence Chinese banks. It even says that banks could keep operating while the prices drop by up to 50%. According to the report, China's Bank of Communications once also released that if the housing prices drop by 30%, it would not lead to a high ratio of non-performing loans. Even if the price drop reached 50%, the non-performing loan ratio would also increase by almost 5.6% in the end. Now the non-performing loan ratio of China's commercial banks is 1%. It means that if the house prices drop by 50%, the ratio will at most go up to 6.6%. The report emphasizes that earlier in 2007, the non-performing loan ratio of China's banks reached 6.6%, while in 2004, it was even higher. Therefore, a 50% decrease in housing prices would still see China's banks unaffected in the long run and operate just like they have over the past 10 years. The report also points out that real estate loans account for 20% of total loans from commercial banks. The price drop in the real estate market will likely lead to a default in these loans, but it's more likely that a large amount of default loans will come from real estate developers instead of the house buyers. The report says banks will be affected to some extent, but the risks are still in control. While that might be reassuring for those with a stake in China's banking system, not everyone is as optimistic. The well-known Chinese commercial commentator Neo Dao is one of them. Neo insists that a sharp price plunge in China's housing market lead to bankruptcy in Chinese banks. Neo says the prices will likely decrease by 80% by 2015, and in that time period, there'll be bankruptcies. This might be a troubling thought because so much of China's economy is supported by banking. But there's also a huge difference between the state-owned banks and the shadow banks. Neo points out that China's housing market in the past 2 years has been very similar to America's in 2006 and 2007. In 2013, the news about housing prices dropping could be heard very frequently. But this hasn't held back Chinese speculators from continuing to buy houses. Houses are still one of the very few investment options for Chinese people. Most don't trust bank products and can't take their money overseas. American house buyers saw house prices drop in 2006. Then a year later, American house prices decreased by 35%. And then finally, this got the attention of American economists. And then in 2008, the subprime mortgage crisis broke out. To give readers a bit of a shock, Neo says that China's real estate market this year is very similar to that of America's in 2007. Neo expects 2015 to be a tough year for the Chinese housing market, especially with the cash crunch in 2013, which he said is a warning signal for a crisis. For those that don't know much about the cash crunch, it was pretty much a deal that allowed a large state-owned bank to default. So to put that into perspective, a bank has already defaulted, but this bank got away with it. It was said that they paid back the loan the next day. But it did hold back other banks from lending to each other, which created a liquidity problem. Neo concludes that a potential financial crisis will cause China's house price to drop by 80% in the end. This would be based on a lack of lending within banks. These banks rely on state-owned institutions, which are their biggest clients. And many of these state-owned assets are in real estate, so this will lead to a bigger problem. This fear of banks going bankrupt is largely connected to housing prices dropping. Since the beginning of this year, the prices have plunged in many cities in China, including first-tier ones. If this drop continues, it could affect the whole economy and bring more risk to banks.